Good morning. Welcome to the B.F. Anderson Technical Report for April 28th. I remember as a young boy, my dad and I stayed up late in Baton Rouge, growing up in Baton Rouge, and I can remember my first hurricane. It was Hurricane Betsy, and Dad and I stayed up all night. Daddy had a battery-operated radio that was the only communication we had. We had hurricane maps that we were, tracking the storm, and actually the eye of that storm went right over Baton Rouge. It was quite an experience. But I was totally enthralled with the idea of understanding hurricanes. And back in the late 1700s, a gentleman by the name of Henry Piddington developed something called the Sailor's Hornbook. Now, I'm going to, of course, show this as a correlation to technical analysis, because what the Hornbook was for the law of storms, and where they would use certain tools and like technical analysis. These are tools. These are ways for the sailors or the captains of the ships to say, we may be sailing into a hurricane. They referred to hurricanes back in the late 1700s as cyclones. And cyclones, the Latin word, stands for eye of the snake. So these sailors, would sail the Caribbean, usually north of Cuba, certain times of the year, mainly August through October. They would have to deal with hurricanes on somewhat of on a regular basis. So Piddington developed something called the horn card or the storm card. And what it was basically, it was a tool where that if you felt that the seas were too high, and you see back in the late 1700s, they didn't have a device that could measure wind speed on a moving ship. So they had to use, the height of the waves, was the cables that held the mast vibrating at a certain level. And so if you felt as a captain that these cards were transparent, so you could lay them out on a navigational map and basically understand the directions of the wind of a typical hurricane or cyclone, and then take defensive action. This is a picture I just happened to like that was, here's a ship that's basically in trouble. They're in very high seas, could be devastating. So like technical analysis, we need to use technical analysis as a tool so that if we do feel that there's a hurricane coming or a bear market coming, or we are in a bear market, we need to know what to do. So I'm introducing another indicator. Now this is something new. We're adding here a monthly chart. We don't have any monthly charts in our work right now, so I thought I would add one. As you can see here, we are definitely on a sell signal on a monthly basis using this particular indicator. Here is the Nasdaq. Let's just go ahead and see what's going on. Also about sailing ships, they developed the barometer in the late 1800s. So, when barometric pressure was dropping, they would see that as well. Well, here with the Nasdaq, we see a definite downtrend, actually broke to a new low. The bottoming process is a process. It's not a point in time. In other words, back here in January, market made a low. You could have said, okay, there's the low. We're in for the low. We get a rally, and then we make another low. And then basically consolidate, rally, and then we make another low. So basically what we're dealing with here is a downtrend, and we're going to have these head fakes, so these rallies within a downtrend. So here's the weekly, as you can see here, getting worse, broke to a fresh low on a weekly basis, and the 35-week moving average has turned down. The Nasdaq has really been one of the most difficult groups to be in. The mid caps, kind of the same thing, breaking below that low here. Here we are with the New York Composite, same thing. So again, the downtrend continues. At best, this is sideways, but as we break to fresh lows, it's something to be aware of. Here's the small caps. You can see where the small caps, which is usually a risk on, risk off index, risk is definitely off. We're seeing another leg down on the small caps. Here's the S&P 500, same thing, rolled over, rally failed, down below the 200-day moving average. On the 35-week on the S&P, we are below the 35-week, and the 35-week has rolled over. So barometric pressure is dropping. Now this indicator here, this is where we're looking at the S&P compared to the 30-year Treasury bond. You can see here that Treasury bonds are actually, interest rates have dropped this week. So we're getting some improvement in the bond market and not much improvement in the stock market. Again, the correlation is usually these things tend to move together. The ratio will move together with the index. Now, on the aggression index, now I must mention the aggression index has been we started using this indicator about 2 years ago. It has been very helpful. In other words, here was the peak in the market in February of 21. We came down, we tested the lower end of the moving averages, rallied back up again, actually made a new high, and then everything fell apart. We broke below here, and again, just like barometric pressure, this thing is dropping, actually making a fresh low. This is basically saying that defensive stocks are outperforming pretty much everything, and it's just something that really tells you that there's trouble out there and maybe trouble ahead. Here's interest rates. You can see here a small pullback in interest rates. Oil, here's the price of oil, just basically moving sideways. But really note here how the financial stocks, meaning the banks and insurance companies, broken below the 200-day moving average and actually making a fresh low. We don't like that. That's not good. Now, new lows, I will say something positive about the new lows. On the first low that we made back in January, we had over 700 new lows. Then the next low that we had around 700 new lows. So the number of new lows are starting to dry up, which it's still too high. The number's still too high. But it does say that maybe the sellers are starting to run out of steam. Now, on sentiment, we got to a record reading last week. This indicator will be updated again today. I have a feeling it's not going to improve much because the market has been acting so squirrely. But the point is that we are in extreme fear. This is usually the place you are when the markets make bottoms. It's just that it can stay there for a while and the market continue to go through the bottoming process. Now, on our trend strength on the Nasdaq, you can see here much more clearly how the Nasdaq is making a fresh low here. We're probably going to get a rally in here, but the trend strength doesn't look good. It is at zero right now because it's not above any of the moving averages. But the other troubling thing is that the moving averages are so, you want that smooth uptrend. And when you get into a downtrend, usually the beginnings of a trend, you get all this confusion. Now, here's the trend strength on the S&P 500, same problem. Again, you can kind of see where it's trying to hold that low, but we are at zero on trend strength. Volatility index, the VIX has really jumped up here. Now, what we're looking for with the volatility index is something called capitulation. Usually when you get to readings up in this area here, like we did back here at this time period, so if the market were to break to fresh lows and then the VIX get up around 40-ish, 39, 40-ish, that could be what we would call a capitulation low. Now, I did want to point out something. I get a question quite often about what do I think of Bitcoin. The only way I can kind of get a handle on Bitcoin is watching this company here called Coinbase, which went public fairly recently, and they're involved in an exchange of these cryptocurrencies. This has been a terrible investment. I mean, I can remember getting people calling me up asking me if they should be investing in Coinbase. But you can kind of see here that this Bitcoin cryptocurrency thing is really kind of not looking all that good. Now, also I wanted to mention also with interest rates, we know that interest rates have been going up. This is a high-yield corporate bond fund. In other words, junk bonds, low-quality bonds. Now, the market is really hitting this group pretty hard, along with the Treasury bonds. But this group is also involved in the possibility of defaults. If we go into a recession, defaults will go up. So you can see here that high-yield bonds are actually starting to really deteriorate. Now, a lot of times I'll run into people and they'll ask me, where can I make a good current return? And, back up in here, you would have been making, maybe 6-7% interest on these bonds. But then you can see that you pretty much in principal loss, you've lost all your improvement due to the interest rates. So let's get into the top five. Now, again, I want to emphasize the top five. We have three lists that we work from, and this would be list number one, where we just look at what are the strongest stocks on the list. And it's not a buy list, it's not a tip sheet. This is nothing more than for us to kind of see of our list number one, what are the strongest acting stocks? Well, this is Lantheus, which is medical supplies. The medical stocks and the healthcare stocks continue to be strong. Here's Mosaic. Now you can see here actually with fertilizers, they have broken down. Again, it's just the strongest group though. It's everything's breaking down. Here's Occidental Petroleum. Again, we were seeing that basing action here, hopefully to see a breakout. But, it looks like oil prices might be relaxing a little bit. There's probably a lot of air in that oil price. So anyway, point is that Occidental has broken down as well. Here's Comstock Resources, another oil and gas exploration company. Again, has broken below the 10-day moving average. Again, just showing some signs of weakness. Antero Resources, another exploration. So in other words, we're saying that we're still seeing a lot of the commodity names in our list. That is really not our kind of thing. It's not our kind of stock. We really like companies that are growing earnings and are in a growth mode. But if you have any questions, let me know. Thank you very much.